Okay, financial analysis and management reporting. In the last class,
horizontal.
I said you would taking a basic, we were covering material as if you were going to receive it in a basic accounting course, or excuse me, a basic finance course. Again, this is something if you take your first accounting course, you would see the same terminology. All right, why do we exercise financial analysis?
Integral parts of the management functions of control and financial management.
I don't know if the video heard you, but we identify and understand
Really? You gotta go
major
there?
components of financial statements. All right, we're going to include methods used by investors, creditors, and management to evaluate past, present, and future financial performance of the healthcare organization. Results of these methods are going to be used to make decisions. So what's the step one?
Establish the facts.
Establish the facts. Compare the facts over time and facts to similar organizations. We want to apply some form of ratio analysis. Who can define liquidity?
It's the ability to pay off your short-term debts
Ability to pay off short-term
in
debts.
the year.
When you hear the word liquidity, how quickly can you take an asset and turn it into its cash form?
1 year or less.
From the county.
You're trying to define a current asset. Liquidity is how liquid. Remember, what's the most liquid asset?
Cash.
Cash. So anything that can be redeemed. But you are right in applying the 1 year period because, you know, if it took you something longer than a year to turn to cash, probably wouldn't call it very liquid. We'll use ratio analysis to define profitability. We can use it to measure activity, capital structure. Horizontal analysis. So step one. Step two, compare the facts over time and facts in similar organizations. Now to do this, healthcare organizations and other organizations are going to apply either horizontal analysis or vertical analysis. What's horizontal analysis?
Evaluation of trends in an organization by focusing on the percentage of change over time. So, x-axis more or less.
How's that? All right, horizontal analysis. Think of horizontal. We're going to compare it to, give me an example. If you took this year's data and compared it to
Previous year, even before that.
previous years or something before that. Vertical analysis.
Evaluation of the internal structure of an organization by focusing on a base number and showing percentages of important line items in relation to the base number.
All right, so here you want to apply some form of, you want to take your current figure and you're going to compare it to a baseline. So if I wanted to take and say net income should be, net income is this, how does that compare to this base number? In year 2007, we had a great year. I want to use that as my base number. Let's just compare current year down to that and see how we measure up. Horizontal, I might want to lay my years out and compare it over a series of time. Whereas vertical, I want to take current data and compare it to some baseline, hence the vertical direction. All right, we can use perspective and judgment to make decisions regarding the comparisons. Okay, first, our financial statements. Kim, what is that basic accounting equation?
I'm sorry. What was the question again, sorry?
The basic accounting equation.
Oh, assets
Assets
equal
equal
liabilities.
liabilities.
Equity.
Yeah.
Liabilities plus owner's equity.
Oh.
What is an asset?
Anything that brings value to the company.
Something that brings value to the company. It is something of value. More importantly, it is something that can be used to earn a profit. It is something you own and intend to use in order to achieve a profit. Assets, liabilities, and owner's equity are shown on the balance sheet. Statement of operations.
It's called the income statement for for-profit organizations, summarizes the organization's net revenues, expenses in excess of net revenues over expenses over a period of time.
Okay. Before we get back into that, does everyone understand liabilities and the owner's equity piece of this equation? Okay. Liabilities, remember, economic obligations of the organization. That is your creditors. In other words, that is your creditor's claim on those assets. The owner's equity piece, sometimes just abbreviated to equity. That is the equity holders. That's their claim on the assets. So that's why this equation will always balance. Your assets are going to be equal to the two parties that can lay claim to them. Okay, the statement of operations. For you for-profits, what might you see this called? Or a variation of this?
Incomes.
Statement of operations.
Statement of operations,
Income
and
statement.
income statement. Okay, so the statement of operations is going to summarize net revenues, expenses, and the excess of net revenue over expenses for a period of time. Here we have it equal to assets equal liabilities plus net assets plus net revenue minus expenses. Next, we're going to look at a statement. If you'll look on page 330, you'll see an example of a balance sheet. Let's see here. Yes, page 330, exhibit 14.1, you see a balance sheet. And exhibit 14.2, you see the statement of operations. Who can tell me what GAAP stands for?
General accounting principles.
Generally accepted accounting
accounting.
principles. Remember, inside the United States, these are the rules and guidelines that companies must follow when they are preparing and reporting their financial statements. Now, I can say that even though you in the healthcare organization might not be reporting to public investors or even external parties, most hospitals are still going to elect to follow GAAP. Most organizations that aren't required to do it will still choose to follow it. Again, it's because of it being a good sound practice that is accepted practice. All right, statement of changes in assets. Who can tell me what this is?
Equity. Equity again.
For-profit organizations shows the reason why net assets changed from the beginning of the statement period to the end of the statement period, as reported in summary fashion on the balance sheet.
You must summarize and explain why there was a change. Statement of cash flows.
The amount of cash receipts and where they came from, and the amount of cash disbursements and where they went during the statement period.
Amounts of cash receipts
Where they came
and
from.
where they came from, and the amounts of cash disbursements and where they went during the statement period. Stated in other terms, all cash coming in the business, just think of it as following the cash. All cash that came into the business, all cash that went out. Okay, it's not in your textbook, but statement of cash flows. I'll point out on exhibit 14.3, all cash enters a business from one of three sources. It comes from operations. It comes from financing. And it comes from investments. So if you look at exhibit 14.3, you see where each one of those categories becomes summarized. Cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. All right, ratio analysis, before we get into that. Any questions on, in particularly, that statement of operations, that balance sheet, or that cash flow? Okay. Those same three statements you're going to find any Fortune 500 company preparing. They're going to call it an income statement, a balance sheet, and a statement of cash flow. But in accounting, those are your three primary financial statements. So remember, balance sheet's going to tell me assets and liabilities and equity. Financial, that's generally referred to as the financial position of the firm. So let's see what assets you have on hand, backing out the claims on those. How financially sound are you? Statement of operations is going to factor in the effects of income and expenses. This is going to be a measure, too, of profitability. And then the statement of cash flows is just a statement to track cash flows. All right, so with the ratio analysis, we said that one set of ratios we would talk about were profitability ratios, asset efficiency ratios, capital structure ratios. Let's look at this case study. Mr. Davis is a financial manager of a pediatric center, has a meeting with the board in a month, and is required to create a financial analysis of the organization. She was asked to compare Clark Pediatrics to other pediatric healthcare organizations in the area to create a trend comparison. What must Ms. Davis include in the financial analysis?
Should need a balance sheet, statement of operations.
Occupancy rate.
Statement of cash flow, statement of changes in net assets. Ratio analysis.
Horizontal analysis, vertical
There's a
analysis.
lot of things that she's gonna need.
What can she do to ensure that she's created a sound report?
She can compare it to other places and see if it kind of generally fits in the same classification of how they're running compared to how she's running. She can have an auditor come in and audit her results.
She can also compare with previous reports as well
Yeah.
to see if they are fairly close. Or not close, but if there's any changes, that they can make sense of the changes.
What decisions could she make?
Decisions regarding capital purchases or investments.
Decisions regarding capital purchases. Again, decisions on how profitable she is. Decisions on how she compares to other or similar organizations in her geographical area. Seeing if she's following the same type of trend. Seeing if she's even compares to the initial base point. All right, what we find next in ratio analysis, on page 338, to the end of the chapter, you're going to have under the liquidity ratios, I want to draw your attention to the current ratio.
Current assets divided by current line.
This is your basic ratio to determine liquidity. Look at what we're doing. Total current assets divided by current liabilities. This is going to be what is the likelihood you can meet these short-term obligations. Higher values mean you have a better debt-paying capability. And again, how do we define current? 1 year or less. We've talked about payback. I would expect your organizations are following close analysis of collection periods. Remember, all the capital that's tied up in the treatment, diagnosis, the treatment, and then how quickly are you paid back? Organizations, again, are looking for ways that they can speed up and create greater efficiencies. You'll have days of cash on hand, days of all cash. All right, so days of cash on hand in the short-term resources and days of cash. These become important liquidity ratios to show us that if there was some disruption in an organization's operations, how many days could they continue to meet their daily obligations? So if you just cut off revenues or you had a disruption in revenues, how quickly could you continue to exist at normal capacity?
True.
What's that?
If Medicare and Medicaid stops paying you.
If Medicare and Medicaid stops paying you.
Hypothetically
That's called
speaking.
immediate jeopardy.
Yeah,
Yeah.
hypothetically speaking.
Average payment period, again, looking at how we can speed that up, how we can speed up the
Pretty good
collection.
on that.
Excuse me, average payment period, how long it takes you to pay your obligation. Now, you would like to speed up the collection But it might not be a bad thing if you can delay the outflow. All right, next we have profitability ratios, operating margin, and total margin. All right, I'll draw attention to the ones that I'm drawing attention for you. I'm going to tell you are the ones that are most used and most relied on. Your operating margin. Operating revenue divided by total revenue multiplied by 100. This is going to show profitability. Higher values are going to indicate higher profitability. Total margin, return on net assets. Okay, return on net assets, basic measure in relationship to any investment. If you're deciding to make these capital expenditures, you're making them and you understand the payback period is there, someone's going to be on the backside measuring the effectiveness of that decision. How efficiently are we using our assets to drive profitability? Okay, because it would do no good if we're making all these capital expenses and we're acquiring all this equipment. If we're not putting that equipment to good use, it's going to show up here in the return on net assets. All right, asset turnover, fixed asset turnover, current asset turnover, and inventory turnover. How many times are we turning over these measurements? Capital structuring ratio is the last category. We have net asset financing, long-term debt capitalization, debt service coverage, cash flow to debt. Your cash flow to debt becomes an important indicator and one that I see widely used. Cash flow to debt measures the ability to meet both short-term and long-term obligations. You've got your obligations that are due. How does current cash flows come in? How do those compare to those obligations? Are they sufficient to meet them? And how do you all get revenue? Put it this way, we opened up with a case of fraud. How did that doctor get revenue? By encouraging people to be admitted and stay. And we do know if someone is admitted and stayed, that drives revenue for your organizations. So operating indicators, average length of stay, and the occupancy rate. I'm going to suggest that empty beds in a hospital are not a good thing, at least to the finance department. It might be well for society, but probably not. And not to the financial team. All right, somebody tell me real quick, what's the purpose of creating a balance sheet?
You have
Where the money goes.
your the amount of money coming in versus going out.
Essentially show where the money is.
At a specific point in time, though.
Good point. Balance sheet is a specific point of time.
But isn't it meant to be kind of like a quick reference? Something that's supposed to be easily understood so that people know how to use it efficiently?
All right, let's go back and look what's contained on the balance sheet.
What's your assets versus liabilities? Your net asset?
Balance sheet contains what?
Your
Current
assets.
assets,
Assets,
liabilities,
Investments.
not investments.
equity.
Equity. Your statement of operations is going to show assets. Liabilities. What else?
Net assets.
Well, owner equity, which is net revenue expenses, or net revenue minus expenses.
Net revenue. Now I'll ask again, what's the purpose of creating a balance sheet?
Show you how much available
Capital.
capital you have to determine if how high your risk is to lend money to you.
All right, let's look at page 329.
Under financial position at a specific point in time.
This is going to show you
The end of an accounting period.
your financial position. Why would I prepare the statement of operations?
It summarizes the organization's net revenue over a period of time.
Summarizes revenues and what?
Expenses.
Anything else?
And excess of net revenues over expenses.
Okay, summarize revenues and expenses. Just so you have a nice picture of all three of these statements. What's the statement of cash flow include?
Cash receipts and cash disbursements.
Liquidity
Where they
ratio.
came from, the amounts of cash
Okay,
distribution, and where
It's
they
going to
went.
show
Cash to
cash receipts and
First,
disbursements. Coming from what three categories?
operating costs,
operations, financing, and investments.
Operations, financing, and investing. All right, somebody tell me, last question. Describe operating indicators used to analyze financial performance of an organization.
Can you repeat that one more time?
Describe the operating indicators used to analyze the financial performance of an organization.
Average length of stay and occupancy rate.
Occupancy rate and
Average length of
average.
stay.
What ratio is going to show me how quickly I can meet short-term obligations?
your liquidity.
Or how likely am I to meet short-term obligations?
Liquidity ratios.
Liquidity ratios, current ratio specific. 4 areas of ratios. You're going to have a nice comparison summary of this chapter right here.
Liquidity,
Profitability.
activity.
Asset efficiency.
Where are you at?
I don't know.
341.
Activity and capital structure.
It just says asset efficiency, I think it's the same thing. Activity.
Activity and capital structure. Any questions?
No.
All right. Thank you all for your participation.